Most people look at tax forms and think, what am I even looking at? That's also probably why you're here right now. The 2026 season mixes brand new deductions and contribution limits with the same old paperwork that can punish you if you miss one single form. Today we're doing a full overview of what's changing in the 2026 tax filing season, and more importantly, what you should do before you file so you don't overpay or trigger avoidable IRS problems. Let's break this down into two buckets. The new tax rule changes that affect your deductions and planning. The forms and deadlines that will matter more than ever because IRS matching is getting stricter. Just a quick note, this is general education, not personal tax advice. If you've got a complex situation, make sure to use a qualified professional. Okay, let's start with the biggest decision everyone still has to make in 2026. Standard deduction or itemized deduction. That choice alone can swing your tax bill by thousands of dollars. A tax deduction simply lowers the income you're taxed on. The more deductions you legitimately claim, the less taxable income you report, and the less you owe. That part hasn't changed. What has changed are the numbers and the rules around them. For the 2026 tax season, the standard deduction is higher across the board. Single filers are looking at a deduction a little over $16,000. Head of household filers are closer to $24,000. Married couples filing jointly are north of $32,000. On top of that, there are expanded benefits for seniors. Taxpayers over age 65 can take an additional senior deduction, and there's also a new bonus deduction available for eligible seniors under certain income limits. This is one of those changes that sounds boring until you realise it's literally free money if you qualify. If you're helping a parent with taxes or you're in that age bracket yourself, this is something you need to check carefully before filing. Now, even if you don't itemize, there's a new charitable deduction to be aware of. Previously, charitable donations only helped if you itemized. Under the new rules, you may be able to deduct a limited amount of charitable giving even if you take the standard deduction. It's not unlimited, but it's still meaningful if you donate consistently and usually don't itemize. If you do itemize, the rules have shifted in ways that could bring itemizing back into play for a lot of people. One of the biggest updates is the state and local tax deduction cap. For taxpayers under certain income levels, the cap is described as significantly higher than it has been in previous years. That's especially relevant if you live in a high tax state or county. Charitable deductions also work differently when itemizing, with a new income-based threshold you need to clear before those donations start counting. Add in medical and dental expenses above a percentage of your income, mortgage interest and casualty of theft losses, and itemizing may suddenly make sense again. The takeaway here is simple. Don't assume the standard deduction is automatically best in 2026. Run the numbers both ways before you file. Now let's talk about two of the most talked about changes for working taxpayers, the new tips deduction and the new overtime deduction. If you earn qualified tip income, there's now a deduction that can offset a substantial portion of that income, as long as you're under certain income thresholds. This applies whether you're an employee or in some cases self-employed, as long as tipping is customary in your line of work. Miss this deduction and you could easily overpay by thousands. The overtime deduction works in a similar way, but with an important nuance. It applies to the overtime premium, not your entire overtime paycheck. In plain English, if you're paid time and a half, it's the half portion that's eligible. If you work a lot of overtime, this can still add up quickly, but only if you understand how it's calculated. Next up are retirement contributions, where the numbers have changed and the rules have gotten more technical. Contribution limits for IRAs and 401ks are higher in 2026, and there are expanded catch-up opportunities for older workers, including a special window for people in their early 60s. For high earners over 50, there's also a rule tied to your W-2 that can force certain catch-up contributions into Roth 401k instead of a traditional one. This is where tax forms stop being paperwork and start being strategy. Boxes on your W-2, specifically the ones showing Social Security and Medicare wages, now influence how your retirement contributions must be classified. If you don't look at those boxes, you could be surprised when your contributions are treated differently than you expected. Health savings accounts also come with updated contribution limits, and they remain one of the most powerful tax advantage tools available. HSAs can give you a deduction when you contribute, tax-free growth and tax-free withdrawals for qualified Medicare expenses. But they also come with reporting requirements when you take money out, which brings us to the second bucket. Most tax penalties don't come from exotic loopholes or aggressive strategies, they come from something simple. The IRS received a form that didn't show up on your return. In 2026, IRS matching systems are more automated and less forgiving. If a bank, broker, employer, or platform sends a form to the IRS expects to see it on your tax return. If it's missing, the system notices. Your W-2 is still the foundation, it arrives by the end of January, and every box on it exists for a reason. Federal wages, federal withholding, social security wages, Medicare wages, all of it feeds into different parts of the tax calculation, and in some cases into new rules. Interest income is another common miss. If you earned interest in a checking or savings account, you may receive a 1099 INT. Even small amounts get reported, that form goes into you and to the IRS, and the IRS will match it. If you invest in a taxable brokerage account, you're likely dealing with multiple forms. Dividends show up on a 1099 DIV, sales of stocks, ETFs, or mutual funds show up on a 1099B. Even if you didn't sell anything, activity inside a fund can still generate taxable events. Retirement accounts bring their own paperwork. Distributions, rollovers, and certain conversions generate a 1099-R. If you're doing backdoor Roth conversions or taking money out of a pre-tax account, these forms need to be reported correctly to avoid double taxation. Real estate sales can trigger a 1099-S, gambling winning can trigger a W-2G, contractor income comes on a 1099-NEC, unemployment benefits and state refunds show up on a 1099-G, health savings account withdrawals show up on a 1099-SA. And starting with this season, digital assets add yet another layer, with new reporting forms designed to give the IRS clearer visibility into crypto transactions. The pattern here is simple but critical. If you've got money from somewhere or moved money in a tax relevant way, there is probably a form attached to it. Here's the practical checklist. First, don't wait until April to start collecting documents. Most forms arrive between late January and mid-February. If you file too early, you risk missing one. Second, decide whether you're taking the standard or itemized deduction by running the math, not just by guessing. Third, if you earn tips, overtime, or have complex retirement contributions, learn the rules before you file, not after. Fourth, review your W-2 carefully. Boxes matter now more than they used to. And finally, understand that software and professionals are tools, not substitutes for awareness. You don't need to be a tax expert, but you do need to know what applies to you. The goal for 2026 is simple: no surprises, no penalties, no overpaying. If you plan ahead, this doesn't have to be stressful, it can just be another task you check off the list and move on. And that's exactly how tax season should feel. Hopefully this video was helpful. If it was, maybe give the video a thumbs up and consider subscribing to the channel for future videos just like this one. Thanks for watching, and I'll see you in the next one.